Hi everyone, my name's Lou Pelathy. I'm here to show you my trading strategy, or at least a recap of the trading strategy. It's February 4th. I'm looking at the S&P 500 SPY ETF. Uh, and I'll show you what I looked at today for the zero-day options, the daily options. So the first screen here, this is trading view, S&P 500. Um, the daily chart is showing a trend of a upward trend in the market, but really broken by today's price action. And that's the down arrow here will show that the support levels were not held, and this was a pretty bearish day today. And VIX climbing higher. It's another indication that the market's moving generally to the downward direction. There's generally a correlation between volatility and negative moves, usually directly correlated. Uh, Not all the time, but in most cases, as you can see here, when it spikes, those usually correspond to negative days. Okay, moving on to the next panel. Let's look at what options that I put on today. These are the zero-day options on the SPY ETF, expiring today, February 4th. So in the morning, I saw the price action kind of open neutral, and the call was to have some choppiness. So I bought the 691, 694 call vertical, and I bought the 689, 686 put vertical. Another way you can think about it is it's an iron condor. I bought the 691, 689 strangle, and I sold the outer strangle, the 694, 686. So in the morning, things were working out for me on the puts, but my calls were losing money. I rolled a strike down $2, but it never really reached my 691 call value. So this ended up a loser for the day, and puts ended up a winner. Overall net negative. So it wasn't a great outcome, but it's less to do with the outcome. It's more to do with having a game plan coming in and sticking to it, and being consistent. So let's look at some of the indicators I look at during the day. One of the one of the better indicators is our gamma capture volatility, the intraday volatility, which is this green line. You can see it was really above the 30-day by quite a lot in the morning. We went all the way up to in the 20s, and that represents this very volatile period right here. And the down arrows are bars. This is a 1 minute chart that are bars that fall outside this gamma capture band. The gamma capture band is a substitute. It's a more reliable and a more stable substitute for Bollinger Bands. So anytime there's a print outside of the bands, either an up arrow or a down arrow will show on the chart. And you can see here the down arrows kind of dominated in the morning, indicating a negative trend. And sure enough, the market did go negative all the way down to the 682 level. Now, this orange line is typically what I use to say, all right, should I close out my current position and move into a 1 day for the following day, or should I keep riding the position that I have? So I just put this as a reminder. It's a 1:30 p.m. Eastern cutoff time, because the zero-day options do not have a long lifespan. You're pretty much right or wrong very quickly. You have a few hours in which to have your position play out, but not much longer. So it's a good idea to make a decision on whether to continue or not. Around that 1:30. 1:30 is because the decay starts kicking in very quickly after this time period, and it's better to take your winnings off the table, or vice versa. Close out your losing positions rather than kind of ride it till towards the end. The green line here above the 30-day will also highlight in green the chart. So these are high volatility areas. When the volatility is below the 30-day, it'll be a reddish highlight. So I can tell which kind of vol environment that we're in. And the bars here, this green bar is the opening range high and the opening range low. So again, at 9:30 on the open, it kind of was in the middle of the range and it immediately dropped below the low of the range. Here it tried to climb back and there was some consolidation. And after the consolidation, when it didn't move higher, that's typically a signal that there's a downward trend coming in. And sure enough, it did nothing but go down all the way till about 1 p.m. where again consolidation here, and then it started to come up again. Never reaching the point where I was, you know, going to make, this call vertical is going to be positive. It was always in the negative. And then finally, here I combine a few different indicators. So this is kind of a busy screen, but I'll go through them one at a time so you can kind of understand what I'm looking at. Again, the arrows are your gamma capture. Um, when a market, this is again the S&P 500 1 minute bars, when the S&P 500 bars fall outside the gamma capture bands, there'll either be an up arrow if it's above the gamma capture band or a down arrow below. So you can see here, the indication of a negative trend coming along the way. Um, Again, the horizontal green is the open high, and the horizontal purple is the open low. Those give you an idea of the opening range such that you can gauge whether or not the market is broken through that opening range. Um, and then these X's are there's a relative strength X's that when the relative strength starts getting negative, there'll be a red X, and when things start trending up, there'll be a positive X. So I just use that as a trend following intraday. And here, these sine waves, those are, again, volatility measures. When the height of the waves go through a certain number, there'll be a little buy signal or a sell signal. So, combining a good strategy and being consistent and cutting losses, those I think are the main drivers of a overall positive P&L. And you can always make adjustments going forward. My adjustment today would have been just to get out of the calls sooner, seeing that the trend was definitely on the lower side. Even if there was a comeback after market hours, I you can always put a call position back on. You don't have to keep the one that's you've currently done. You can take this off at a loss and then lower your strikes, and hopefully, the rebound will then make you money because, hanging on to a losing position, it's never a good idea. It's the 0 day options are there's not enough time for them to kind of go back into your favor. When the time runs out, like that's again this orange bar, when the time runs out around 1:30 p.m., it's time to make the decision to cut your losses or take your gains and then re-strike your options. And I typically like to do 1 days after 1:30 because again, this after 1:30, there's not enough time for your views necessarily to make sense. So I usually use the 1 day after the 1:30 mark. So that's the recap for today, February 4th. Thank you guys for listening, and I hope you guys have a great trading day tomorrow.